There are several variables behind this, including default rates having already moved higher in early 2020 and substantial refinancings of debt already occurring in 2020 and 2021, therefore reducing the number of maturities outstanding in 2024 and 2025. Although the cost of capital has increased as the Fed has raised rates, in our opinion, the number one indicator of default is a rapid deterioration of interest coverage ratios, while high-yield issuers' interest coverage ratios remain very healthy, where the majority of interest payments in the high-yield bond market are fixed. In addition, companies themselves are earning higher rates of interest on their cash balances, and the paydown of debt and deleveraging remains a priority. Good companies actually pay down debt when rates are high, and broadly, high-yield issuers are protecting margins and cash flows over revenue growth. This does not mean there will not be defaults in the broader market, but they will occur in the lower cohorts, or likely in the riskiest securities and in passive strategies that do not protect their investors with credit research. From our standpoint, we see the default cycle as normalizing and very manageable. Using the 0 to 5 high-yield market as a proxy, this demonstrates the asset class de-risks as it gets closer to maturity, as there is less business uncertainty and confidence increasing a company's ability to repay debt with cash or to refinance. As an active manager, we are focused on the three main risks that cause bond prices to move up or down in price, with the solution keeping tight bands around duration and an average duration below the market to remove the rate volatility, credit underwriting, and research that is focused on U.S. companies that provide important services, goods, or critical infrastructure to the U.S. economy. A focus and preference for liquid bonds in a deep and well-defined U.S. credit market that is very important in times of global uncertainty, and a portfolio that consists exclusively of bonds that pay coupons in U.S. dollars.